All right, folks, we are up and running, and like I said, I want to do, one of our colleagues in here had asked me to take a look at a risk that they have on, and I really haven't even looked at it yet, but it's based on a type of spread that we, pardon me, that we will not use here at Prosper in any of our options plays, but it's something that you should know about, and it's something that's out there, and it's something that is that is used by professional and maybe even some retail traders alike. Okay, so this is an example of what's called a ratio spread. And Robin's asking about the CRM. And yeah, my signal, in Scott's word, he got a little piggish. I put out a 130 bid, he put out a 125 bid. I didn't see any fills. I was hoping, because it's higher now, but that's okay. Okay, so this is called a ratio spread or a 1x2, and it happens to be in Wayfair. W. Let me get that up on the board here. And the spread that he has on is an April 18th, 152 half, 155. And like I said, 152 half, 155. So buying one and selling two. And it was put on for a credit today, because we can see that if we sell two of these things at 107 and we buy one at 165, well, that's 214, so that's 35 and 14, so that's 49. So now it's trading for 50 cents. So he sold it for $1 credit, and now he's buying, and now he potentially can buy it back. Okay, so now how is this different, and why can we not do this, or why won't we do this as the signals that we put on? Because remember what I say about these spreads, just don't make them overcomplicated, break it down into what it is. Let's get the spread calculator in here. We have the 152 half, 155. We buy one, we sell two. And we received a credit of $1. Okay. So the issue is, all right, so anywhere from 152 half and below, we just get to keep that $1. Actually, I'm curious, since we don't do these ratio spreads, same thing. Okay, so I received $1. So anywhere below this, we're gonna have 3 worthless options, and so I get to keep my $1. Now, if we go up to 152 half, or then I still keep my $1. George, was that live? Sorry, I'm circling back on CRM here. Okay, there might be more out there. We'll see. So at any rate, getting back to this now, if we go up to let's say we go up to 153 and a half. Well, that's still good, right? Because now we have one that is a $1 in the money that we own. We still get to keep this first $1 that we got, so we actually make $2. Where's the best place to go in any of these vertical spreads? Right to the short strike, right? What's my mantra? Maximize the things you own, minimize the things that you don't. So now we have a 52 half call, that's $2.50 in the money. We have a 55 call that's still worthless. So we make $2.50 plus we keep our $1. we make 350. So why wouldn't we do these type of spreads? And also, if you want to think about it this way, what we've done, this is simply a call spread and then selling an extra call. So why wouldn't we do these trades? They work, but you know, they can potentially work better than a vertical spread. You're getting a credit to take a long position. Infinite upside risk, right? We know that we can only make $2.50 on this, but this 155 call, well, you know, you're in trouble. Well, potentially in trouble, because if we go up to, let's say, 160, it's actually it's 2.5, 157.5, 157.5, Mike. There we go. So now we have a $5 call. That's $5 in the money. That's good. But we have two calls. Each of them are worth $2.50. So on the options we make nothing. We still get to keep our credit. But now what's the problem? Well, we go up to 158.5. So 158.5. Well, now we have a $6 call that's in the money. We have two 55 calls that are $3.50 each against us. So we lose $1 here. We get to keep $1 here. That's our break-even price. The issue then becomes, okay, what happens when we go to 160? Well, now we're starting to lose money, and potentially, you know, if this thing blows up and goes to 175, well, now we got real problems. So they can definitely be, they can, you know, it's definitely a valid approach. It's one that is typically not traded by a retail trader for this reason. One, you know, it's not a great idea to trade with infinite risk at all if you're not significantly capitalized. But, and also a lot of us can't short sell. We just can't sell naked premium the same way that we can't sell straddles, strangles, unsecured puts, can't sell naked calls without owning the underlying. So as long as you know your risk, that's what you need to be looking at. So here as it stands right now, you sold it for $1 and you get to, you could, you know, the market now is a 20-cent credit at 80 cents. So, you know, somewhere around 50 cents. So as long as you know what your risk is, you're cool. Just be careful. Any questions on that? Like I said, this is something that you won't see ever in a signal coming from anybody here at Prosper. But it's important to know. Well, that's what that's the issue. If it moves up fast, here, you know, it goes up to 175. I know that's, you know, a big move, but you know what if they get bought out? You know, Walmart wants to buy them out or something like that. And this thing, you know, they say, hey, we're going to pay, you know, we're going to offer shares at, we're going to bid 180 for these things. Well, this is going to go up to at least 175. Well, 153 in a day. Well, I mean, you could, because the price of the options can be whatever they want. This is at expiration, right? The market determines what the price is. Theoretically, at expiration, this is what it would be worth. That was a back spread though, right, Richard? That's when, didn't you buy two and sell one? Richard said that Scott did have a ratio spread on in VIX in February, and I do recall that. I don't recall the exact thing, but I believe it was what is called a back spread. That's when you sell one and buy two, taking the exact opposite tact here, saying that there's a really good chance that VIX is going to spike. There's buy one, sell two. I'm going to have to check with Scott with that, because how do we do that with unlimited upside risk? I'm almost sure. Let me see if I can go back and look here. February 1st. Yeah. I don't. This is the email that went out. We're selling one, we're buying two. Selling one 18 call and buying two 20 calls. And then you were paying a debit of 65 cents for it. I don't know exactly how this one turned out, but like I said, I would be very surprised if a ratio spread was put out, and I would hope that, you know, if I had done that, he would come over and talk to me and see what the heck I was doing. No, don't worry about it. Don't worry. Don't be sorry. But yeah, so you can take the other side of this as a retail trader for sure. Because then, let's just say that we took the opposite side of this person's position. Well, then all I've done is I've sold a call spread, and I've bought an extra call. Now, you need that. You need a big move. Either, you know, in the case of where I can't remember exactly where volatility was when that February went out, but I'm sure that there was two things. One, that VIX was low, and implied volatility in VIX was low. So that would be an example of when it would make sense with that. Because not only are you do you have the directional thing that if VIX were to blow up, but you're also going to be long Vega. May have lost on it. That happens. That doesn't mean it was the wrong. Remember, you can lose money on good trades, and you can make money on bad trades. That doesn't make the good one bad and the bad one good. Sometimes you just get lucky by doing the wrong thing. Okay, so I did record this. Let me get this out here, and then I'll get it rendered and put up in the room. Thank you for the example. Like I said, it's important to know what it is, but you won't see me putting out any ratio spreads. Let's put it that way. All right. Thanks a lot for the example.